Hello everyone and welcome to this video. In this video, we will understand how do we do the historical analysis and we will understand the projection criteria for item of the income statement. Before that, I want to tell you 4 steps when you want to forecast any item of income statement, balance sheet or cash flow. You will go through 4 steps. For example, if you want to forecast, let's suppose dividend, then it will require 4 steps to perform. First step is to collect historical data. The second step is to do the historical analysis. Third step is to take assumptions, and fourth step is to make forecast. Now if you want to forecast, let's suppose dividend, how will you do that? The first step will be to collect historical dividend. Then the second step will be to calculate dividend payout ratio. That is the criteria to forecast dividend. One of the criteria to forecast dividend payout ratio or dividend per share. So let's suppose we want to forecast dividend based on dividend payout ratio. So first you have to collect historical dividend. Second step is to do the historical analysis. That means you have to calculate dividend payout ratio in the last 3 years. Then based on historical analysis or based on management guidelines or based on the information given in the research report prepared by some other investment bankers, or based on the knowledge that you have obtained about the company, you have to take assumptions. After you have taken the assumption, then you have to forecast dividend based on dividend payout ratio that you have assumed. So now let's talk about if you want to forecast capex, capital expenditure. Capex is capital expenditure, opex is operating expenditure. Now to forecast capital expenditure, you will require 4 steps. First step is to collect historical capital expenditure. Second step is to calculate capex as a percentage of sales. Capital expenditure as a percentage of sales is the criteria to forecast capex. So first you have to collect historical capital expenditure, then you have to calculate capital expenditure as a percentage of sales. Then based on historical analysis or based on management guidelines or based on the assumption taken in the research report prepared by other analysts or based on the information, based on the knowledge that you have gained about the company, you will take certain assumption. Based on those assumptions, you will be forecasting capital expenditure for the future. So what is assumption can be taken based on historical analysis, that's one thing. Second, management guidelines. Third source is research reports. Research report by, let's say, Morgan Stanley, Merrill Lynch, Barclays, SBI Capital, or there are hundreds of analysts or investment banks, research companies which are providing research reports. So you can look at those research reports also to frame your assumptions. The fourth is your knowledge about company or your objective will define what should be the assumption for future. So what I have talked about just now, that if you want to forecast any item, it will require 4 steps to perform. The first step, you have to collect its historical data. Second, you have to do the historical analysis. Third, you have to frame assumption based on historical analysis, management guidelines, research report, or your knowledge about the company. You will have to take assumption. Based on the assumption, you have to make forecast in the 4th step. So now what we have done so far, we have collected historical data. The second step is to do the historical analysis. Just to give you another example so that things are clear to you. If you want to forecast, let's suppose inventory. So first step is to collect historical inventory. Second step is to do the historical analysis, wherein you will be calculating inventory as a percentage of COGS. Then in the third step, you will take inventory as a percentage of sales. You will assume what will be my inventory as a percentage of COGS based on historical analysis, based on management guidelines, based on research report, based on your knowledge. You will be taking assumption for future. Based on those assumptions, you will forecast inventory. I hope now you should be clear what I am talking about. What are the 4 steps that you have to perform to forecast any item? Now let's come to the income statement, and here what I will do, if you want, you can do the historical analysis just below the income statement, or you can create a new sheet. Okay, to make it simple, I would prefer to keep the historical analysis below the income statement itself. So here you can type historical analysis. So I am going to write the projection criteria. So sales growth rate, COGS as a percentage of sales, SGA as a percentage of sales, other expenses or incomes we are not going to forecast because these expenses are generally not forecasted. We do not forecast other expenses because these items are not recurring in nature. So something which is not recurring, something which is not related to the core business of the company, we do not forecast it. So stock-based compensation will be forecasted as a percentage of sales. After this we have depreciation and amortization. For depreciation and amortization there will be a separate schedule. I am writing it for your reference only, that there will be a separate schedule. No, not a direct assumption here itself. Then next item is interest expense. Interest expense will be forecasted in a separate schedule, so I will not be taking any assumption for this here. Income tax. Income tax will be forecasted based on effective tax rate. The next item is reserves. So minority interest. Minority interest will be forecasted based on growth rate. Then we have reserve. Reserve as a percentage of profit. After reserve we have common dividend and preference dividend. So common dividend will be forecasted as dividend payout ratio. Dividend payout ratio. Preference dividend will be forecasted based on preference dividend rate. Then we have DDT. So DDT rate on common dividend, DDT rate on preference dividend. So in this video I have just listed the projection criteria. So whatever will be my projection criteria, I will calculate that in history first. What do I mean by that? If I have to forecast sales based on growth rate, so I will first calculate the growth rate in history. Same way COGS is forecasted as a percentage of sales, so I will calculate COGS in history. Likewise, minority interest I will forecast based on growth rate. So minority interest growth rate will be calculated in history first. So if I change my criteria to forecast, I will change the historical analysis also. The criteria to forecast which I have written here, it may not be same in every company, but for this case study these are the criteria to forecast. So we will do the historical analysis in the next video. Thanks for watching.